It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
Well, from the Secure Act 2.0 to the One Big Beautiful Bill Act. How's that for a tongue twister? Man, we've had some major tax law changes in recent years. And that makes it crucial that you understand how these new tax laws impact your financial life, and also vital to make sure that you are implementing wise tax planning strategies to maximize those benefits. In today's episode of the Wise Money Show, we're going to be helping you with both of those so you can pay the least amount of tax over your lifetime.
If not multiple lifetimes. That's right. And we did a show a month or so ago, sort of explaining the new tax laws, or most of them that will impact you. And today we're reviewing those again, but we're taking more of a planning approach. What do you need to start doing right now? What do you need to start doing right now to not only take advantage, but to really optimize, to maximize these new benefits? If you have a question for the program, we'd love to hear from you. You can call or text us 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com is where you can find us. Leave questions there as well. Most question comes through engagement on social media, YouTube channel, that sort of thing. So wherever you're at, we are there as well. Search the Wise Money Show. So yeah, it's been a couple months since the new tax laws were passed, beginning of July. And first show, we sort of explained the what. And we've got to shift from what the laws are to how do you maximize them. From, okay, let me understand it, to how do you implement it? How does this implement your planning and your strategizing? So all of this is connected to tax planning, one of the 6 areas of your financial life.
Yeah, it's a crucial one. And especially in the fall, it's kind of that season. If you're not already thinking about how your tax picture is going to be different here in 2025 compared to the last time you filed a tax return, man, it's time. It's time because the world around you has been shifting and changing because of these tax law changes. But I just have to assume that something has changed in your own personal finances as well. There might be new opportunities, new goals that you're prioritizing, new resources that you need to be building into your planning. But now is the time to be sketching out a blueprint for what you want your tax picture to look like, while there's still time to implement the ideas. By the time you get to tax filing season in the spring, that's really just compliance work at that point. It's really just capturing on paper what it is that you already did in 2025. And often a lot of the good ideas that were available to you, they start going away at the end of this calendar year. So taking these last few months of the year to really dial in on what you could be doing proactively within your financial life to improve your tax picture itself. Man, now's the time to be doing that with your certified financial planner.
That's the proactive and creative strategizing work. That's the tax planning side. Tax preparation, that's coming. It's April 15 every year, or October 15 when you include your extension. But the planning, that's the creative, that's the strategy, that's the paying the least amount of tax over your lifetime. And all these tax laws, we're going to hit the new changes within the OBBBA, but also some of the Secure Act 2.0 changes that take effect right now that you need to be implementing in your planning this fall. Let's start with the new SALT cap, okay? That's part of itemized deductions. So explain quickly the standard deduction versus itemized deduction, and then what can you be doing right now to plan ahead to optimize, make the most of the new SALT cap change?
Well, okay, so when you hear the phrase tax deduction, sometimes people refer to those as tax write-offs, but essentially it's a way for you to reduce the amount of income that you're going to have to pay taxes on legally. So if you can erase income or drive your income on the tax return down, that means less tax. More income means more tax. And so there's 2 different ways that the government allows you to take a large tax deduction. There's the easy way and there's a better way. Not everybody qualifies for the better way because easy is good enough for them. But the government will allow you to take a standard deduction this year And it's the easy button, as I said, or you can itemize your own list and come up with a better number. And this is where things like medical expenses and taxes that you pay to your state and local government, state and local taxes, SALT is the acronym there. So when you hear us talking about SALT deductions, that's what we're referring to. This is one of the categories of expenses that you could build your own deduction with. And then things like mortgage interest and charitable giving is another way that you can compile or itemize your own list of expenses and get an even better write-off if you have good record keeping and the numbers accumulate high enough.
And when you think about those deductions, think about on your federal income tax return. So these are related to your federal income tax, and you say, why was there such a thing as the SALT limit? And I like to say SALT tax, just like you would say ATM machine or some of these other things. But why the limit? And basically the idea was in the blue states, think California, New York, or Illinois as an example, they have meaningful property taxes.
Yeah.
And if you were paying your property tax bill, it's not uncommon. I have a friend in Chicago that pays $25,000 a year in property taxes.
Wow.
Well, all of a sudden he's qualified. But when they came in and they said, hey, we're going to cap that, what you can deduct for not only your property tax, but what you pay in state income tax, what you pay for the tags on your car, health, mortgage interest, all this. That's not perfect, but if you were going to cap your SALT tax at $10,000, all of a sudden it went away. Like, I don't need to pay attention to this anymore. Either I can't or I can, but it changed people's habits and behaviors. And now we're saying lean in because it's back on the table and there are some things that you may want to do, especially, and just as a little bonus, if you were a business owner, there was actually a workaround of the SALT limit.
Mm-hmm.
So
this is major for a lot of people because even if you don't live in one of those states where the property taxes are just through the roof, as Kevin was describing, you may live in a state where there's a state income tax. Yep. And there might even be a county tax. There might even be a city tax, some sort of local municipality that's hitting you up. And this can add up to many, many thousands of dollars, maybe tens of thousands of dollars that you're paying out in taxes to other governments beyond the federal government. And it used to be that, well, at least the consolation prize for paying all those taxes was you get to write them off on your federal return until that $10,000 cap came into play. And so for many people, tens of thousands of dollars of tax deductions went away, which meant that they're going to pay tax on tens of thousands of dollars more in income. All of that just translated into bigger tax bills. Now that the SALT tax limit or cap is no longer going to be at $10,000, it's moving up as high as $40,000. Many more people are going to be able to get many of those tax deductions back on their tax return.
And so that's what I want to talk about, guys. So how do you optimize? How do you so if you once were not itemizing because of this cap at 10 grand, now it's 40 grand and you think you're going to itemize, how do you maximize that? What are the strategies? First one, we've already been working on with some folks is if you think you're going to owe state taxes this year and you're going to show up by the time you file your taxes in the spring and you're going to have to write a check to the state and, oh, yep, I had dividends or capital gains that landed on my tax return or some income on my tax return that I didn't withhold enough for, and maybe because my income has been going up and so I paid in enough, but I'm still going to owe a little bit, you're going to want to pay that in 2025, whether a withholding or an estimated payment, and your estimated taxes for the fourth quarter aren't due until January 15, but you want to pay them in this calendar year so that they show up as part of your state and local taxes that you paid, as in part of that calculation in the SALT cap and the SALT calculation. So being aware of that, I know that doesn't apply to everyone, but if you think you're going to itemize, ensuring that you're making enough state and local tax payments so that you get to optimize it. I was working with some folks where they, based on, they were gonna owe on the state taxes, but without doing anything extra, they were gonna get about $35,000 paid in those state and local taxes. Nope, we're gonna pay an extra amount to ensure that they hit that $40,000 cap and avoid having to pay anything when they file their taxes. That's just a little bit of what you need to have on your radar screen from a planning standpoint with the new itemized deductions. We've got that more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel every Saturday, 10 a.m. Eastern Time, also on podcast at the same time, and also on a couple local radio stations at the same time as well, which is why the content's broken up the way that it is and has we meander and get off topic and all that sort of stuff. It's a talk show. But if you're looking for more direct content related to the new tax laws or some of the tax strategies that you should implement or any other financial planning strategies, we've got that right here on this channel as well. Well over 1,500 videos, next wise step videos that air right here on this channel all throughout the work week. So make sure you hit that subscribe button, turn on notifications so you're made aware every time we drop new content. If you like the content, we appreciate it. Thank you. All right. So we started scratching the surface right at the end. We'll pick it right back up.
With SALT still, right?
Well,
we need to at least talk about the phase out. And
because that's the other part of the planning. Right. So the big idea, what are the decisions and planning you need to do right now to make the most of this?
Yep.
All right, here we go. Many more people are going to be itemizing their taxes this year, starting right now, 2025, than itemized last year because of the SALT cap increase, moving from 10 to 40,000. But there is a gotcha in there. There's a phase out you need to plan around, and there's some other strategies you need to be aware of. We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Wherever you listen, just search the Wise Money Show. Subscribe to it there. Rate the program there as well. We appreciate it. Okay, guys, we're talking about things that are actionable. You need to be changing and shifting your planning for right now when you're doing your tax planning this fall based on new tax laws. Many of them in the OBBBA and some with the Secure Act. We're going to get to that too. But the first one is SALT deduction. Standard deductions have gone up this year. It was going to be $30,000. For married filing jointly, it's $31,500. Okay, and $15,750 if you're single. Those have gone up. That increased with the One Big Beautiful Bill. Still, because of the SALT tax cap going from $10,000 to $40,000, many more people are going to itemize. If you think you're going to, or if you're on the cusp, how do you optimize it?
I think paying attention to these thresholds for income, not everybody gets to get the full $40,000. If your income as a married couple goes over $500,000, then you're going to start to be phased out of that $40,000. It'll bring your cap back down 30 cents on the dollar every time you go over that $500,000 income level. And it's half that amount for a single individual, by the way. So this is one of those times, it's yet another example of where managing your income and paying attention to the thresholds that are going to apply to you is going to be really, really crucial. But I would also encourage people, if you are a business owner who over the past couple years has been bumping into this $10,000 cap, it's been a problem for you and many other Americans for a long time. One of the workarounds that existed was for you to use your business to pay these state income taxes instead. And the business was able to write it off as a business expense, which gave you effectively the same tax benefit, essentially, without running into the cap. So you may need to be still playing a little bit of that game. And this is where you and your CPA, you and your certified financial planner can try to optimize which strategy makes sense. Maybe you're using this business loophole, if you will, to pay some of the tax, and that makes more room for the higher real estate taxes that Kevin was talking about in the last segment. So the only way to do this math is to crunch the numbers and be looking at a tax projection and playing around with different scenarios on how you're going to pay these state and local taxes.
I think the planning is in three areas with the SALT cap change. Okay, first is if there are state and local taxes that you're going to owe, get them paid in this year so that they count towards this higher limit. That's the first one. So make sure your estimated payment, all that stuff that I shared before, that's one. The second one Josh mentioned, and that is if you're close to that phase out of $500,000, if you're in that range, and you might say, well, that only applies to a few people. I know folks that can afford to pay a lot in property taxes or that pay a lot in state taxes. That is connected, that's correspondent to having high income. And so if you think you're close to that threshold, starting now in September, starting that planning process to stay below those thresholds so that your SALT cap doesn't get reduced back down to 10,000. That's the other part of the planning. But then third, if you, because of this new SALT cap, if that's going to shift you from, well, I'm not paying $40,000 in property taxes and state and local taxes, but this does mean I am going to itemize, then okay, if you're going to itemize, what are some of the other things that you can ensure that you optimize for your itemizations? The primary one, don't go out and get a mortgage, right? Mortgage interest is one of the things that you get to deduct. But one thing in your control or your choice is charitable donations. And I'm not saying go be charitable because it's going to benefit you, but be aware of that and be aware of what year. The other part of that is the deduction and benefits that you get for charitable deductions. That's changing with the One Big Beautiful Bill. However, it's changing in 2026. So in 2025, that's the only year that we've got the expanded SALT cap, meaning more people are going to itemize with the same and familiar charitable deduction rules. In 2026, that SALT cap is going to be high, but the charitable deduction rules are changing. And it's going to be a threshold that you need to get over before you can itemize or before you get to claim them on your itemized deduction. And so this year, 2025, pairing the SALT cap and charitable deductions is a unique thing. You need to be planning for that right now when there's still 3 months left of the year.
Yeah, if there's any message, it is get the meeting scheduled and see what it is I can do to optimize my tax situation. Many times when we meet with clients who've never worked with a certified financial planner before, the question is, well, who helps you with your tax planning? And they hesitate a little bit, and then they say, well, this person does. And then I kind of gently prod a little further. I'm like, well, so they do your tax preparation. What are the best ideas they've given you in the last couple of years? And they would say, well, yeah, I mean, they don't really help with planning. Because in order to do planning, you have to have a pretty amazing view of someone's personal financial landscape. Again, if you're alive, you have 6 areas to your financial plan. Who can see those 6 areas? Do you have visibility? Is your financial life decisionable today? Can you see it and make decisions? Do you have clarity and confidence? Because that's what you need in order to be able to optimize your tax situation.
So that's the SALT cap change and how you need to be planning ahead for that. I'm going to cluster 3 others together, and they all share a similar theme. These are new OBBBA deductions, but the planning around them, it's a little bit different. We're going to take one at a time here, but it's the part of the idea is making sure that you keep your income below certain thresholds and having some awareness of this, and these thresholds don't align with anything else. They're new. But this first one is the new senior deduction. You might have heard it called no tax on tips. Nope, that's not the rule. No tax on Social Security. That's not the rule. Tax on Social Security is still working like it used to, okay, which is a really complicated formula. That's staying the same. But instead, what was passed is a $6,000 deduction if you're age 65 or older and your income is below certain thresholds. So if that's you, how do you maximize that this year? The big thing is likely if you're 65 or older, in your retired, you have some choice as to what income lands on your tax return. Being mindful of that and staying below those thresholds, that's key to maximizing this tax benefit.
Mm-hmm. This is something that's only going to exist for the next 4 years, 2025 through 2028. So there's a 4-year window here where you're exactly right. All of a sudden, if your income goes over $150,000, you may stop getting some of this extra tax benefit, this tax deduction that Mike is referring to for people over age 65. All this is stacked on top of your standard deduction, which is also increased a bit, $31,500 for a married couple. Throw 12 grand on top of it for that same married couple, and all of a sudden there is a major portion of your income that can be completely eliminated or wiped off of the tax return if your income stays low enough. And so we're often talking about strategies that maybe people would want to actually increase their income. We talk about Roth conversions all the time. That is a way to move money from your IRA to your Roth IRA, but whatever money makes that transition is going to be counted as income for you. What if you accidentally push your income too high because of a great move like that? And because of it, you start to lose some of these deductions. You would want to know that before you pull the trigger on any of those proactive types of strategies.
Yeah, I mean, doing a Roth conversion for sure. But the other thing is, if you're drawing Social Security, if you're retired, drawing Social Security, and you're supplementing that Social Security with withdrawals from your IRA, here in September, if you're looking and saying, yeah, I mean, that automatic withdrawal is happening, and when I add everything up, doing this projection, my CFP is telling me that I'm going to land around $175,000. Well, could you pause some of those withdrawals from your IRA these last couple months and stay below this $150,000 married filing jointly limit? By the way, it's $75,000 for single filers. Could you do something and reduce the amount of what you're taking out of your IRA? And you say, well, okay, I'm just not supposed to live the lifestyle I want. Maybe you draw from cash. Maybe you draw from a Roth. Maybe you draw from an HSA. Some way to creatively keep your income below those thresholds so you can take advantage of these tax benefits for this short window while they're around. More planning with this new deduction and others, that more coming up on the Wise Money Show with Korhorn Financial Group.
Yeah, or you push the expenses into next year.
Mm-hmm.
I mean, there are many awesome ways to get creative.
Well, there's a few others with this that we need to talk about, or at least one other, because it's not tied to Social Security. It's tied to 65 or older. And a lot of 65-year-old people are still working. Mm-hmm. So, I've been throwing money in my Roth, or no, I've been putting that money in my pocket because I want to build up cash before I retire. Well, if you're close to this threshold, maybe you got to pivot your strategy and start throwing that in pre-tax in your 401k. Mm-hmm. So let's hit that, and then no tax on tips, no tax on overtime. Very similar thing. How do you shelter your income so that you stay below the thresholds? So,
yeah, we're talking about our anger management issues. The complexity of this.
Yeah, that's what I'm saying. All right, third segment. Here we go. Okay. The OBBBA introduced some new tax deductions, but it's not for everyone. It's only if you qualify. And one of those qualifications is your income needs to be below certain thresholds. This is a very, very, very clear theme coming out of these new tax laws. I think it'll be a theme for future tax law changes as well. Planning is what helps you stay below those thresholds and maximize these benefits. That's what we're helping with right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Josh Gregory and Kevin Korhorn. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. All right, the new senior deduction. You might have heard of it as no tax on Social Security. No, the tax on Social Security is working the way it has in the past, and that is there's a calculation that's done when you're on Social Security where you add up all of your other income, IRA withdrawals, yep, interest from the bank, yep, dividends, yep, pensions, yep, all your other income plus half your Social Security. As soon as that exceeds $25,000 if you're a single filer, or $32,000 if you're married filing jointly, some of your Social Security starts landing on your tax return and becoming taxable, okay? The higher that equation, or the higher that the result is of that formula, more and more of your Social Security becomes taxable. Up to 85 cents of every dollar of Social Security isn't taxed, or isn't the tax on it, but it is taxable. What was passed in the new bill is a $6,000 per person senior deduction. You've got to be 65 or older and your income needs to be below, this modified adjusted gross income needs to be below 150,000 married, filing, and jointly, or 75,000 for single filers or all others. You don't need to be on Social Security to get this new deduction. So the last message to help you plan ahead is if you're 65 or 66 or 67 and you're still working, even if you're not on Social Security, you can still get this benefit. You just need to be, again, age 65, check, and below those income thresholds. So if you're working, that means you get to save into a retirement plan. And you might, at this stage of the game, you might be thinking, no, I want to save up into cash so that I've got more cash when I retire. Or we really want to be aggressive with paying down some debt. Or we really want to do some traveling. Or I don't have a lot of tax diversification, so we're putting everything in Roth. All that stuff is important. Financial planning and a comprehensive approach to your finances is looking at all of those important choices and figuring out, well, right now, this season, which is best. And it might be best for you to contribute more pre-tax at that stage so that you can keep your income below certain thresholds and all of a sudden get these deductions. Anything to add? Sorry, I went on a rant there.
I don't think so.
Okay. So that's a similar theme. With these new tax deductions, what's the planning you can do to keep your income below certain thresholds to maximize it? The next two I'm going to lump together. No tax on tips, no tax on overtime. That's what they're being called. That's not what is actually happening. It's no federal tax on qualified tips up to a certain limit, $25,000.
$25,000, right?
And then no federal tax on some of the overtime premium up to $12,500 per person.
They were smart. They built in a gotcha in this one because my mind was like, well, everyone should be paid by tips now, right?
Yeah.
Or at least 25 grand. But they had a provision in there that said you have to be working in an occupation that I think the phrase was customarily and regularly receive tips. So financial
Which
advisors,
is everyone now, right?
Yeah,
Like
pretty
everyone's
much
got the tip jar out
the
there.
Grocery store will ask for it sometimes. It's
It
pretty
is,
crazy.
oh, that boy, that's another rabbit trail because when you go to the gas station to pay for your gas, and before you can actually pay the amount, it says, "What do you want to tip this person?"
Yeah.
Yeah, that
And
we were talking about things that drive you crazy, and that one ranks very high on my list.
But there you go. I mean, so we're talking about income phase out. So if that's you, say you work in a role that is you primarily do get tips. The tax deduction, you still have to pay payroll taxes and all that. You still have to pay state taxes. You just get a deduction on the federal taxes. But it's only if your income is below certain phase outs. Yeah, I know, Mike, we heard you. You've been talking about it for 5 minutes now. It's probably the same phase outs as the Social Security one, right? No, different.
It never is,
no,
right?
Different. This 300,000 married, filing jointly, or 150,000 for others, unless you're married, filing separately. So you might say, I'm getting tips, and my income's that high. Yeah, there's no planning here. No, I mean, what if there's your two-income household, and one of you is primary breadwinner, and the other one is helping out somewhere and working part-time, and that part-time gig happens to have tips on it? Yeah, you need to be aware of this threshold. What if you are in a rocky spot with your spouse, and you're trying to rehabilitate the marriage, but from a tax standpoint, you guys have just decided we're going to file separately, but one of you is in a tips-paying job? No, married filing separately is exempt from this benefit, right? So there still could be some planning, and that planning is A, awareness, but B, awareness and leveraging the deduction to keep your modified adjusted gross income below those thresholds.
Am I right in remembering this only exists for the next 4 years also?
Yeah.
So, this is maybe buying votes on the next round as well.
Yeah.
Vote us back in so you can keep your free tips and.
Yeah, the specific occupations have not been defined yet.
Yeah, there's a list coming out later in October, right?
By the time this airs, you might.
Right. There's likely eligible, which would be servers, bartenders, hotel staff, hairstylist, and select ride share roles. I am fascinated by ride share companies, and it used to be you actually could not tip them within the app. And now they've made it where you can tip them within the app. And my understanding is 100% of that tip goes to the driver, which is kind of a cool thing.
You know what?
That's your retirement dream job, isn't it?
Well,
I wish if there was two of me, one of me be driving right now.
so if you get the opportunity to be in an Uber or a Lyft with Kevin Korhorn, you're going to enjoy it. So make sure you got a warm drink and just sit back and enjoy, because he has fun, and he will ask the drivers. We get a lot of stories. We even had one, I think the last one we were in together, we invited the dude to have dinner with us. And he did.
Right.
And it was great. But you get to hear these folks' story, and a lot of folks that are driving, that's their, hey, I early retired, I'm enjoying it. Most of them are invested in Bitcoin, by the way. And so anyway, so one other, I'm not stereotyping, just based on the number of stories that I've heard, but So one other, so you might say, well, if you're driving, you're not going to have $300,000 of income or $150,000. You might not have that in wage income. Mm-hmm. You might have that because you sold some Bitcoin, or you sold a property, or you received an inheritance, or some other things outside of maybe your normal control, and you're not thinking of that as income, quote unquote. That all of a sudden disqualifies you from this. And I know we're talking about the tip one, but the overtime one probably is going to apply to more people. I know everyone reports all of their tips all the time. Overtime, right, might actually apply to more people. The phase outs are the same: 300,000 married filing joint, 150 for everyone else, except married filing jointly, you don't get, or married filing separately, you don't get anything. And the benefit here is just a federal deduction only on the overtime premium. So it's not the time and a half, it's the half, okay, on only up to $12,500. But there again, if that income phase out is total income, modified adjusted gross income. So that might not be, well, what you're earning at that job. It might be some other income that's landed on your return.
And we go quickly through this, but I hearken back to a time when we were doing deep work on a Wednesday, and all the advisors were in the room, and we're talking about doing tax projections for our clients, and how difficult it really is to understand. Even if you ask a client, hey, what will your income be this year? There are so many variables. And you think, well, certainly everyone would know. No one knows. No one. If you said, does anyone know, or no one knows? If you said no one knows, you'd be more right than not.
You know, I said earlier in the show that tax planning is something that you do in the fall every year, but man, stuff like this, you really need to be doing it in the spring. You need to know early in the year whether or not your contributions to your retirement plan should be Roth or traditional. Because if you decide, in October that, oh boy, I'm flirting with one of these thresholds, I need to get my income down, your 401k at work might be a fantastic tool for doing that, but you can only make the change at that point moving forward in the year, and there's just not enough of the year left right now.
Yeah.
You needed to maybe be making some of these types of changes back in the spring. So even when you're in tax preparation mode, I encourage you to flip the switch and get into tax planning mode as soon as possible.
That's right. All of that impacts your planning right now. All right, we got more coming up here on the Wise Money Show with Korhorn Financial Group. Okay, that was the third segment, right?
Yes.
Yeah.
So what's next?
Same thing, but we're done with OBBBA.
So I would
Secure Act 2.0.
Then I would throw in right now just bonus content from a hot off the presses article. Fewer than 9% of all U.S. tax returns will qualify for the new no tax on overtime deduction created by the OBBBA.
Fewer than what percent?
9%. So 1 out of 10 tax returns. And so the confusing thing is, if you're going to a tax preparer that's hustling during tax season, if you're 1 out of 10, do you think they're going to easily select you out?
Do you think no? This is what Kevin said. Do you think they're going to look and say, okay, you've got qualified overtime, you're just above the limit, you could contribute a little bit to an IRA, or you could max out your HSA and get the full benefit? They're not going to tell you that. They're just going to be rushing to get it done.
So overtime pay is still subject to payroll taxes, but the deduction will reduce federal income taxes. Now, that means I'm paying state income taxes on that piece. Yep. It'll save eligible taxpayers an average of $1,400 a year. And overtime workers can only deduct the amount that exceeds their typical pay rate, not all their overtime pay.
Right. So when you're getting time and a half for everything over 40 hours, it's only the half on the hours over 40 that actually counts. So the devil's in the details. It's not nearly as good as it sounds in the headlines.
They promised the moon and they're delivering street lamps. It's big hat, no cattle, all sizzle, no steak. I mean, we could go on.
Before you blow us up, I obviously there is an imbalance. There's a severe fiscal issue going on in the U.S., and so we're not saying freebies for everyone, but yet at the same time, yes, they campaign. Everyone, both sides campaigned on delivering the moon and delivered.
Much less. I mean, if I could stand up and say, hey. One of my campaign promises was no tax on overtime and no tax on tips, and I delivered that. I actually could say that. Is it from 0 to 100%? Is it 100% true? I don't know. I'd say maybe 56% true. If it's 50, I mean, when you were working with your kids, if you said 56%, if you give me 56% of the truth about what you did last night, is that the truth?
Hey kids, we're gonna have ice cream tonight. Okay, cool. Wait, Dad, what's this bowl of broccoli? Well, I mean, you're gonna get something tonight. Sure, you can. It's frozen.
Yeah,
broccoli.
no, we went to the Gilroy Garlic Festival and we're having garlic flavored ice cream tonight.
All right, here we go. Last segment, Secure Act 2.0. There's 3 things that I think we'll hit. I'm hoping to hit. Maybe only get to 2. We'll see. Oh, my goodness. The mandatory Roth stuff. Okay? That's what we're going to touch on. Mandatory Roth for catch-ups. Obviously.
If your income's over the
145. But your plan has to allow for Roth contributions. Most of them do, but not all. Your plan needs to be restated by October 1st of 2025. So we've got to be telling plan sponsors right now, you're already late. You need to run.
Get on it.
Yep. All right, here we go. Thanks for being here. This is the Wise Money Show with Cohorn Financial Group. My name is Mike Bernard. With me in the KFC studios, Kevin Cohorn and Josh Gregory. Every episode of the Wise Money Show, as well as a lot of other content, is on the YouTube channel. Go check it out. Go to YouTube, search the Wise Money Show. Subscribe to it there. Rate the program there as well. We appreciate it, and you can share videos and leave comments, questions as well. Go to YouTube, search the Wise Money Show. All right, we're talking about tax planning changes that you need to implement in your tax planning yet this fall based on new tax laws. So much of that was new tax laws from the OBBBA. Salt tax cap change, new deductions via senior deduction, the tip deduction, and qualified overtime deduction. But that's not all. That needs to be incorporated in your tax planning that's changing this year. There are some meaningful changes going on right now from the huge tax law changes that happened a couple years ago. The Secure Act 2.0, that had over 100 big tax law changes in them, and they were introduced in stages, okay? These need to implement or incorporate in your planning right now as well. The first one is the super catch-up, okay? So what's that mean, Josh? Let's explain that.
Well, you have to pause and at least recognize first that if you have a retirement plan at work, let's say you have a 401k or a 403b retirement plan that you're contributing to out of every paycheck, you have a cap on how much you're allowed to contribute. It's $23,000 for everybody, unless you're over age 50, and then you're allowed to do some additional contributions that we refer to as a catch-up contribution. And the normal catch-up contribution for individuals that turn 50 or older this year is another $7,500 on top of the $23,000 that everyone else gets to do. Unless you're over between ages 60 and through age 63 as well. So there's another little window of ages here where there's extra contributions, a super catch-up contribution, as we would say, that makes your contribution level go up to your catch-up go to $11,250 this year. This is for each individual. Again, it's just for this narrow window of time, And why they capped it at age 63 and not taking it all the way to 65 or some other age, I don't know.
Why put an end date to that?
Yeah.
Why?
It makes total sense.
No, yeah, okay. So, but here's the thing. We've been talking about this, and we've been talking about it because it influences your planning, and it's wildly confusing, and we want you to maximize it. They've made these confusing laws, and we can get frustrated by it, or we can leverage it. And how are you going to leverage planning ahead? But here's the thing. It's now the fall. Mm-hmm. This is when you're going to either do those super catch-up contributions or not. If you had planned all year, oh, that sounds nice, guys. I don't have the cash flow to do that. Now take a look and recalibrate. Is there a way for you to goose up your contributions a little bit before the end of the year and take advantage of this benefit?
Yeah, I think I'm wearing one pair of pants in a bunch of different pockets. So could I pull money out of my savings account in order to replace what I'm putting into my retirement plan? And I'll tell you one of the coolest stories I've heard on this catch-up piece, the 60 to 63 piece. I was actually in Senegal, Africa, with an organization that my wife and I are a part of, and there was a guy there who's a minister from the Chicagoland area, and he's 60, and he said, "Hey, do you know what I'm doing? I'm doing the super catch-up in his 403B."
Yeah.
And I was so proud of him. And David, if you're listening, I am very proud of you. I mean, it is so cool when people understand this and they kind of geek out, but you have to do it. And this is where there are allocation decisions that need to be made. You have to work within your plan rules. The plans has your plan been restated? Because if you don't understand how retirement plans work, retirement plans have what's called a plan document that governs what you can and can't do within the plan. And you say, well, wait a minute, if our plan started in the year 2005, the rules in 2005 were dramatically different than they are today. And that's true. And what happens on an ongoing basis is called a plan restatement. So your plan document is restated to accommodate these different rules, these contribution limits, all of these other things, because if you didn't do that, it'd be obsolete.
We've said this before, but the only way to contribute to that retirement plan through work is out of your paycheck.
Yep.
You can't be listening today and realize, oh, wait, I turned 60 this year. I can do more. You can't just write a check to get yourself up to that super catch-up contribution limit right now. The only way to do it is to increase the contributions that are coming out of your paycheck. And there might just not be enough year left. There might not be enough paychecks left for you to get there unless you dramatically increase. Well, what do you do then if all of a sudden between here and the end of the year, you need to be contributing 80% of your paycheck in order to hit the limit? How do you live off of such a small take-home paycheck? That's where Kevin's analogy of pulling money out of a different pocket in your pants to live. Instead of you living off of the paycheck that's landing in your bank account, maybe this is a small stretch of time between here and the end of the year where you want to proactively really crank up those contributions to the 401k or 403b and just live off of some additional savings that you have instead. Drain some accounts so that you can get all of the goodness out of this. That might be a strategy that makes sense for some people, but it's one that you want to be talking about with your CFP.
Yep. Connected to that is a tax law change from the Secure Act 2.0 that was supposed to take effect in 2024. It's going to take effect instead in 2026, but it's based on your income in 2025. Make sense? Yeah, not to me either. It's the mandatory Roth catch-up contribution. Now, it's not for everyone, but if you make more than a certain amount, $145,000, and this is not, oftentimes when you say, when you have income of this or make this, well, what income are you talking about, buddy? Like, please help explain this to me. $145,000 of social security wages from that employer that you're using their 401k. I know that's a lot of words. I think that's as simple as it can be stated. If you switch jobs, yep, it is did you make over $145,000 of Social Security wages from that employer in 2025, in the previous year? If you did, then any catch-up contributions you make starting in 2026 it's required that they go into the Roth. You mean even these super catch-up contributions? Yep, they have to go into the Roth. Does that mean, well, now that I'm painted into a corner, this stinks, I'm not going to do it? Absolutely not. This is a huge benefit still, even though this is a restriction. It's a huge benefit to be able to stuff more money into your retirement accounts, into these different pockets at this later stage of life via these catch-up contributions and super catch-up. You just need to know those dollars are going to be going into the Roth side of your 401k, not the pre-tax side.
I'm glad you said that last comment there about how your super catch-up contribution has to go into the Roth side of the 401k, because you may be hearing us talk about how, it's got to go into the Roth. You might be thinking we're referring to Roth IRAs, and we're not. We're talking about the retirement plan at work. That's the only place that these super catch-up contributions even come into play. There's no such thing as a super catch-up for your IRA or your Roth IRA, which is the whole reason why this has to be dealt with early enough in the year to be able to fund it out of your paychecks, because you're not going to have the ability sometime in April next year of funding this after the fact like you can with an IRA or a Roth IRA.
So here's the planning point. If you know, I'm not switching jobs, I'm going to make over $145,000 in 2025 from this employer, and I am eligible for catch-up contributions or super catch-up. I'm going to be making catch-up contributions in 2026. Know that those catch-up contributions have to be Roth, and adjust be aware of that from a cash flow standpoint. That means it's not going to be a deduction on your paycheck. You're going to have more taxes withheld. Your take-home pay is going to go down, and that's okay. If you run a company right now and you are what's called a plan sponsor, you need to make sure that your plan allows for Roth contributions. Otherwise, no one at the entire company can do a catch-up contribution. No one can, okay? Your plan needs to be restated to include Roth contributions by October 1st. You've got a couple of weeks if you're a plan sponsor to make sure that your plan allows Roth. Otherwise, you're not just going to mess things up for folks that are age 50 or older, you're going to mess things up for everybody. It's going to be really stinky. So work with your certified financial planner and your retirement plan advisor on that. Big point of all of this, start that tax planning. It's the fall. Rules have changed. Do your tax planning with your CFP. That's all the time we have for today. But you have Josh Gregory, Kevin Korhorn, all of us at KFG. Have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.